You know how we're always digging around for those nuggets of wisdom in, well, pretty much everything.
Hmm.
Today feels a bit like we've stumbled upon, I don't know, the secret notes of some kind of financial explorer.
Ha! Yeah, absolutely. And this particular map, let's call it Philip Fisher's Common Stocks and Uncommon Profits, isn't about buried gold, maybe, but something, well, arguably even more valuable for you listening.
Right. The real secrets to building long-term wealth through, smart investing.
Exactly.
And you, listening, you shared this book with us. You're keen to get past all the daily market noise and really understand the bedrock principles, the things that can lead to significant lasting gains.
Hmm.
So think of this as your personal deep dive into Fisher's thinking. We're going to pull out the crucial stuff, focusing on what you need to know to get up to speed quickly without feeling totally swamped by information.
That's the plan. We've got Fisher's insights on finding promising companies, understanding management, navigating market swings, all drawn directly from his own experience and his core philosophy.
Including those famous 15 points.
Including the 15 points, yes. Our mission today is really to distill that into actionable insights, stuff you can actually apply to your own financial path.
Okay, let's get into it then. Fisher's whole approach seems, well, it seems built on finding these solid growth companies and then just sticking with them for the long haul.
Yeah, it's almost like a counter-narrative to all the constant trading chatter you hear, isn't it?
It really is.
And what's really insightful, I think, is his conviction that figuring out what to buy, that's the main job.
That's the heavy lifting.
Exactly. As he put it himself, something like, if you figure out the right things to buy, selling becomes a lot less important because you can hold the stocks you own longer.
That's powerful. That idea that good upfront research means less need to constantly tinker.
It's fundamental to his whole philosophy. And those 15 points you mentioned, that's basically his toolkit for making those smart initial choices.
And this wasn't just theory for him, was it? He actually used this stuff, the points and his Scuttlebutt method,
Oh, yeah.
and got some pretty impressive results, even early on.
Absolutely. He wasn't just an armchair theorist. Fisher really wasn't one for just following Wall Street rumors or the herd.
Yeah.
He championed this proactive approach he called Scuttlebutt.
Scuttlebutt, okay.
It means getting the real unvarnished truth about a company directly from people who actually know, people outside the usual financial bubble.
Right, like you said, from Main Street sources.
Exactly. Finding out if a firm is strong or weak from, customers, competitors, suppliers. His feeling was that too many investors were getting information secondhand, often from people with their own biases.
So this Scuttlebutt idea,
Hmm.
it sounds like more than just skimming the annual report. How does someone actually do that?
That's a really key question. Fisher stressed going straight to the source, basically, thinking beyond the official press releases.
Okay.
He suggested talking directly to a company's customers, find out how satisfied they are, talk to their competitors, gauge their strengths, their weaknesses relative to the company you're looking at.
Even competitors, wow.
Yeah. And suppliers, too. Are they reliable? Do they pay their bills on time? He even mentioned talking to research scientists in related fields or executives at trade associations. They can offer unique perspectives.
That sounds like, well, like investigative work almost.
Mhm.
But wouldn't people be hesitant to talk,
Yeah.
especially about negative stuff?
Ah, you've hit on a crucial point there. Fisher was adamant about guaranteeing confidentiality. Absolutely critical.
You have to promise.
You have to be crystal clear that you'll never reveal who said what, and then you must honor that promise. Otherwise, yeah, people won't share the real insights, especially the critical ones.
Makes sense.
But doing this gives you such a richer picture. Real-world intelligence you just won't find buried in the financials. Think about, say, a coffee shop chain you're considering investing in.
Okay.
Scuttlebutt means talking to customers about the coffee, the service, the atmosphere, talking to suppliers about their dealings with the company, maybe even discreetly talking to former employees about morale and management.
Got it. That paints a much clearer picture of how involved that is. So you gather all this intel. Then how do you actually size up the company? That's
Yeah.
where the 15 points come in.
Exactly. Those 15 points are his specific checklist, if you will, criteria to evaluate a company's potential for really significant long-term growth.
And he said they don't have to hit every single point perfectly.
Right. He made the point that a company could still be a great investment even if it doesn't tick every single box, but importantly, it shouldn't fail on many of them.
Okay, let's unpack a few. Give people a feel for them. Point one is market potential.
Point one, yeah. It asks, Does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years?
So looking beyond just a quick bump.
Exactly. Fisher argued this kind of sustained sales growth is way more attractive than, say, a one-off profit boost from cutting costs. He used Alcoa, the aluminum company of America, as an early example.
Yep.
Even its visionary founders couldn't have fully grasped the huge, enduring market for aluminum that eventually developed. But he also stressed that even in promising industries, like chemicals back then, consistently growing sales really depends on the quality of the management.
So it's not just the market, it's the team steering the ship.
Precisely. Having the right leadership to actually capture those opportunities.
And point two, that's about continuous innovation. Management strive for that.
Yeah, for Fisher, long-term success wasn't just about riding the current wave. Point two asks something like, does the management have a determination to continue to develop products or processes to keep increasing sales even when current products mature?
So always looking for the next thing.
Always. He believed real lasting growth comes from constant innovation, fueled by consistent investment in R&D research and development.
Right.
And he warned against companies that sacrifice that long-term research for, hitting quarterly numbers. He mentioned an oil company that shut down promising projects too early, wasting talent. Terrible move long-term. But then he held up Dow Chemical as a positive example, their long-standing commitment to R&D, always looking ahead. It's about a culture of continuous improvement.
Okay. Moving down the list. Point six, profit margins. What was he looking for there? Above average.
Exactly. Point six asks, will the company likely enjoy above-average profit margins? Fisher saw this as a really critical sign of a company's strength, its competitive advantage.
And its ability to generate returns.
Right. High margins could come from different places. Maybe they're super efficient, low-cost producers. He mentioned Nucor, the steel company, as an example of great management achieving that. Or maybe they have strong branding, unique tech, a great reputation that lets them charge more. But he did warn investors, be wary if profit margins are going up only because they keep hiking prices without adding real value.
Good point. Okay, point seven is maybe less obvious. Labor relations. Why did he care about that?
Well, he understood that a happy, engaged workforce is a huge asset. Point seven asks, does the company have outstanding labor and personnel relations?
Beyond just avoiding strikes, I assume.
Oh, definitely. While avoiding strikes is obviously good, he argued positive relations lead to higher productivity, lower turnover costs, which are significant, and just a better, more collaborative work environment overall.
Which helps innovation too, probably.
You'd think so. He suggested looking for signs like grievances getting settled quickly and fairly, and wages being above average for the area. A motivated, stable workforce really helps the bottom line.
Okay. And point nine, financial strength, funding growth.
Right. Point nine asks, does the company have sufficient financial strength to fund its growth? Fisher's take was that a company's cash on hand, plus what it can reasonably borrow, should cover its likely capital needs for the next few years.
Just the next few years.
Yeah, his reasoning was, if the near-term growth prospects are genuinely strong based on the other points, investors shouldn't worry too much about financing way down the road.
Because the growth itself will help.
Exactly. Higher earnings would likely mean a higher stock price, making it easier to raise capital later if needed. Don't let distant worries overshadow strong near-term potential.
These 15 points really do give a detailed blueprint. But what about dividends? Lots of investors focus on those. What was Fisher's view?
Yeah, this is where his thinking might differ from, let's say, traditional income investors. He argued that for growth-focused investors, the current dividend yield is way less important than the potential for big future income and capital gains.
So reinvesting is key.
Absolutely. He strongly advocated for companies to plow earnings back into the business to fuel more growth. He famously said something like, for those desiring the greatest benefit from the use of their funds, dividends begin rapidly to lose the importance that many in the financial community give them.
So a high dividend isn't always a good sign.
Not necessarily. He cautioned it isn't automatically a sign of safety or a good investment. He thought sound dividend policies were consistent based on what earnings aren't needed for maximum growth. Young, fast-growing companies, they might pay no dividends for years.
Because they need every penny for growth.
Right. They're prioritizing reinvestment.
Makes total sense if growth is your main goal.
Ah.
Okay, so we've looked at what to look for. What about the pitfalls? The common mistakes Fisher warned against. His list of don'ts.
Ah, yes, the don'ts. He had 10, I think, and they're still incredibly relevant.
Yeah.
First off, he warned, Don't buy into promotional companies.
The hype stocks.
Pretty much. Those early-stage ventures with lots of buzz but maybe not much of a track record or a proven business model. Too risky, he felt, for most individuals who can't provide management expertise themselves.
Stick to established players.
Generally, yes. Second, don't automatically ignore a stock just because its price is low.
Oh, why is that?
Because sometimes, he argued, a low price reflects a temporary issue, or maybe potential that the market hasn't recognized yet. Especially if there's been a positive change in management that isn't widely known. It's an opportunity for those who, as he put it, think for themselves.
Interesting. What were some other key don'ts?
Well, he cautioned against over-diversification, spreading yourself too thin.
Really? Everyone talks about diversification.
He believed in really understanding the businesses you own, so a more focused approach. Fewer companies, but ones you've researched deeply. He even suggested maybe putting 20% of your initial investment into each of just a few top-tier growth companies.
Wow, that's concentrated.
It is. And he also said, don't automatically sell a winner just because it's become a bigger part of your portfolio, as long as the business itself is still strong.
Don't trim your flowers to water the weeds kind of thing.
Exactly. Another big one. Don't assume a high price-to-earnings ratio, a high PE, automatically means there's no more growth potential.
Because the market might expect continued high growth.
Precisely. Companies with sustained high growth potential often trade at higher PE ratios. The key isn't the ratio today, it's the future growth prospects. And finally, a really important one. Don't confuse stock market forecasting with investing.
Trying to time the market.
Yeah. He thought economic forecasts were often unreliable and just distract you from the real work, finding excellent companies. Focus on the business, not the crystal ball.
Sound advice. So beyond the numbers, beyond the points, Fisher put a huge emphasis on management quality, didn't he?
Oh, absolutely massive. For Fisher, the quality of the management team was paramount, maybe even more important than hitting all 15 points perfectly.
What defined quality for him?
Two main things. Business ability, meaning both efficient day-to-day operations and smart long-term strategic thinking. And second, just as crucial, integrity.
Trustworthiness.
You have to be able to trust the people running the company with your money. He even had this unique way of finding talent, offering brief meetings to young investment pros, then keeping in touch with the really exceptional ones. Though apparently he only followed any one person into a stock once. Very high standards.
Wow.
He advised looking for management with a genuine long-term vision, committed to sound growth, not just, paying lip service to it.
And one last thing, the efficient market idea.
Yeah.
Did Fisher buy into that? The idea that all information is already baked into the stock price?
He was pretty skeptical of that, at least in its strong form. He firmly believed that real bargains, undervalued companies can be found.
If you do the work.
If you do the diligent, deep research, understanding the fundamentals that maybe the broader market is missing or misinterpreting. He pointed to the big price swings you often see in individual stocks as proof that the market isn't perfectly efficient all the time.
So opportunities exist.
Definitely. His whole approach was about finding that intrinsic value, not just following market trends.
Okay, so as we wrap up this deep dive into Philip Fisher's wisdom, what are the absolute core takeaways for someone listening? The actionable stuff.
Well, I'd say remember these crucial points. First, prioritize finding companies with strong, sustainable growth potential. Use thorough research, use the 15 points as a guide, and definitely try to do your own scuttlebutt.
Get out there and talk to people.
Exactly. Second, understand that holding these quality companies for the long term is absolutely key to unlocking their value. Patience is vital.
Right.
Third, don't get too hung up on current dividend yields if you're focused on growth. Reinvestment is often more powerful long term. Fourth, be really aware of those common investor mistakes, chasing hype, automatically writing off low-price stocks or high PE stocks without digging deeper.
Avoid those don'ts.
Avoid the don'ts. And finally, always focus on the quality and integrity of the management team. And remember, the market isn't perfectly efficient. Your own diligent research can uncover real opportunities.
His emphasis on that deep individual company analysis rather than just broad market predictions, it really stands out, doesn't it?
It really does.
It makes you wonder, especially today, with information coming at us from everywhere, how can you, listening, actually carve out the time and develop the skills to do that kind of insightful scuttlebutt in areas you're interested in?
That's a great question to ponder.
That might just be the next step in your own learning journey.
Indeed. We really hope this deep dive has given you some valuable practical insights from Philip Fisher's timeless work. If you have more questions or want to explore any of this further, please do let us know.
We're always up for another deep dive.